Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and joined by my co-host,
Andrew. Bills, back again.
We are always back again, Andrew, week in, week out. This is our thing, my man. So hopefully doing some justice on the airwaves of Spotify, Apple Podcast Store, and the Google Podcast Store.
That route and you're like, oh crap, I don't know how do I get out of this now?
I think they're the three main ones that we're on, right? So
yeah, basically.
There we go. No, just trying to interject a bit of fun into these sessions. So
yeah, mix up the intro a little bit because it's always all the same. So nice to mix it up a little bit and keep us on our toes.
And trying not to sound like a sports commentator, right? So I kind of feel like I'm commentating the horses coming down the straight. So Andrew, how you been going?
Yeah, all is well, Bills. Everything's tracking all good and back on for another podcast.
That's it. Well, something a little bit different for our listeners today. We don't really do a lot of this or haven't been in the environment that we've been in with our clients, but it's starting to become a bigger and bigger consideration of ours and something that's been there for a long time, but a lot of people may not necessarily know about this. So it'll be a really good opportunity to be able to talk about this particular thing. And I'm trying not to give it away here, but this particular thing and build up some suspense, but because it is gaining some more and more attention. And when we do talk to clients about it at the moment, they seem to be resonating quite positively with it, just with all of the volatility that we're experiencing in investment markets. Andrew, over to you. What are we talking about?
So today, what we're talking about is capital guaranteed funds. What that essentially means, it's investment options and investment products that allow you to invest in growth assets, shares, property, infrastructure, all those types of assets, and invest with zero risk. So what we're doing is basically not taking on any risk and still having exposure to growth assets and potential upside on the flip side of it as well.
Hang on, you can invest with no risk?
Yeah, I mean, look, that's usually the first question that most people have, because in any investment, regardless of what you're doing, there's always kind of a risk return matrix. Like you're always talking about, yes, we can do this. This is the expected outcome. However, this is the risk that's involved with it. And most of the time, investments will follow that methodology. However, some fairly clever product manufacturers have now allowed us to have another tool in our arsenal, which is investing in growth assets by taking on zero risk. And it's not too good to be true.
But that's exactly what I was just going to say. So these investment products, I guess it's fair to say and to point out, they've been around. It's been something that's not necessarily new. Different providers have them, so it's not just one product manufacturer on the market that has it available. It is something that has been around for quite some time. In a rising market, you don't really use one of these products, and we'll talk about some of the drawbacks and the downsides to these products as well too, but it just hasn't necessarily been something that we've been looking at in the type of market that we've been in. However, obviously now things are starting to get a little bit more volatile, still needing to take the opportunity of having your wealth creation grow, because obviously that needs to happen, while trying to eliminate and minimize as much downside risk as you possibly can as well. So this is becoming quite an attractive proposition to a lot of clients that we've been talking to about recently. But just to point out, it has been something that's been available in the marketplace for a long period of time, and there's multiple product providers that do it. It's not just one.
Yeah, exactly right. And at the end of the day, I mean, in any environment, embarking on a product like this or an investment like this, most of these products will require you to lock funds away for at least 5 or 10 years. And so it's a long-term investment. That's how they essentially do it, because they're not going to guarantee that the investment is not going to go down in 6 months' time. They're taking a long-term investment view and are saying you have to commit the funds for at least 5 to 10 years, because they're banking on the fact that in 5 or 10 years' time, the market is going to be higher than where it is today. And so in almost any market environment, you'd expect that in 5 years' time, the market will be higher. And so even if we're talking the shortest time frame, which is 5 years, it's something that's spoken more about today purely because of everything that's currently happening. But it doesn't necessarily mean that just because there's some volatility now, you want to run scared and run to investment vehicles based on fear. You want to make it on a logical decision. And there is a way that you can structure these products in a portfolio that makes sense, that allows you to have the best of both worlds. But I think one of the things to note is these investment products will have a long-term implication, and you really need to take a long-term view with the funds because you're investing for really a minimum of 5 or 10 years in order to be able to make the most of these capital guaranteed products.
Which really matches with fundamental principles that we talk to people about all the time. Like, you shouldn't be investing for a short period of time and exposing your money to risk. So that just goes in line with an investment principle that makes sense. You are going to experience volatility. You need a longer time horizon to help manage that and smooth that out. With some of these products as well too, minimum time frame you were talking about, Andrew, with these, it's important to point out some products do allow you, if you need to break that and you need to pull out your money because circumstances have changed, there is that option as well too, but you will lose the guaranteed feature.
Yeah, which is, I think, taking it one step back. If we look at what is the capital guarantee, most of the time, and what we're talking about now is the general products. Each product has their own specific benefits, their own specific structure, and so they don't all operate in the same way. But generally speaking, there's usually two methods of having this capital guarantee. Method number one, which is in my mind the easiest and simplest to understand, is you put an amount of money towards this investment vehicle. It's a one lump sum and that's it. So you can't contribute to it on an ongoing basis. You can't draw funds out of it on a regular basis and take a pension from it or whatnot, but you put and invest one lump sum. Let's say it's a 5-year time frame. You invest $100,000. And that $100,000 is capital guaranteed. So if that $100,000 in 5 years' time is worth $200,000, then fantastic. You haven't needed to use the feature and you pull out $200,000. So there's no cap in terms of the actual growth that you can invest in. But if that $100,000 in 5 years' time is only worth $80,000, what you withdraw is actually $100,000. So it locks in your original investment and it will never dip below that. The market value may dip below it, but it's if in 5 years' time is still below it, you'll receive your original investment back, not how much it's worth at that point in time.
So essentially with this one, it's setting the floor price, and that floor stays there or is really only comes into effect when the investment matures. In this instance that you were talking about, it was for 5 years. So if the market value of the portfolio is below that in 5 years at the maturity date, the investor will receive their essentially the floor, which is the 100,000 in that example that you were giving. Or if it's above and beyond that, they'll get the market value of the portfolio at that particular point in time.
Yep.
Yeah, okay.
Exactly right.
Pretty straightforward to understand. There's also a second option as well too, Andrew, that's quite common as well. You want to run us through that?
Yep. So second option is the floor is set each and every year on the policy anniversary. So let's use that exact same scenario, right? We've got $100,000 investment. We put the money in, that investment continues to grow over the course of the next 12 months. And 12 months later, that 100,000 is now worth 110,000. The floor is then set at 110,000. So on each year's anniversary, you're resetting the floor so that it goes to 110,000. That sets the floor in year 2. Then it goes to 130,000. It sets the floor in year 3. But investment market turns, and all of a sudden, that $130,000 investment at the end of the term, so at the end of 5 years, is now only worth $100,000. You don't receive your $100,000 investment back. You actually receive the $130,000 that was locked in year 3. So basically the floor of the investment continues to reset each and every single year.
So it resets the floor price up, but not down, obviously.
Exactly.
It's on the anniversary date each and every year. Yep. Okay.
Exactly right. So if that $130,000 portfolio, if in year 4 it drops down to $120,000, your floor is still set $130,000, and so you're only resetting it when the investment market goes up on the 12-month anniversary, not if the investment goes down. Naturally, the biggest difference that you'd naturally expect between these two types of products, whether you're investing on a 5-year time or a 10-year time frame, whether you're resetting the floor each and every year or whether the floor is just set at the start of the period, all of those things are largely impacting the cost of the product. So if you're resetting the floor every single year, naturally it's a more expensive product. Whereas if you're just setting the floor at the start of the period, then it's a less expensive product than resetting it every year. So all of these will sort of need to go into the blender and try and determine what the most appropriate situation is or what the most appropriate product is for your situation. But there's certainly a few ways that these types of products can be structured.
That's a good conduit, Andrew, into some of the benefits and features and then some of the drawbacks associated with these products as well too. But interesting enough to point out, you can use it for ordinary monies and superannuation monies as well too. So these products are available anyway. You're not restricted to a particular type of investment like superannuation fund. So that's interesting enough to point out. You touched on it before, but these products, our opinion, you're paying a premium for that peace of mind. It can get very, very expensive in order to have this mechanism and this particular type of product available to you. We're talking in the vicinity of 2% in terms of
sometimes
cost?
even higher.
Yep.
Like, look, to put it into a bit of context, where normally you'd expect a similar fund manager to potentially charge 0.6% to funds under management, maybe a little bit more, a little bit less, you'd expect this type of fund managers to charge 2 to 2.5%. So it's a fair whack more expensive than it would otherwise cost to not have the capital guarantee feature. But naturally, you're getting something for it, and what you're getting for it is peace of mind, and what you're getting for it is the ability to invest in growth assets without having exposure to downside in terms of market fluctuation.
Yeah, it's interesting enough. I'm just thinking about the longer term time frame, and depending on the timing of this thing and when it's triggered and what type of market is happening at that particular point in time, but you're foregoing, I guess, the costs to try and offset what the future value of the portfolio is going to be depending on the time frame of the investment that you've selected. So yeah, interesting one with that. Another thing to point out, you can't invest into these things regularly. You need to set it with a lump sum amount of money at the start. So there's no ongoing contributions. You can't continually add to it like you can with other types of investments. And the other thing too is you can't create a regular withdrawal plan. So you can't draw an income or a pension from it. Once that money is contributed, it's basically locked in and it's set. I mean, you can still access it. You'll forego the guarantee, but you can't add to it. It's just designed for a lump sum amount of money to go in and not be touched for a long period of time.
Yeah. I guess the difficulty with that is a lot of people, unless you're utilizing it for a specific purpose, if you're accumulating wealth, then a lot of the times you're contributing towards your investments because you want a dollar cost average, you want to invest on a regular basis, you want to do all of the right things from an investment perspective. So there's some limitations around contributions. But on the flip side of it is you think about who these types of products are really most suited to, and that's your retiree clients. You're retired, you're not wanting to expose your assets to risk, but you're still wanting to have an element of capital growth from your assets. And yes, it meets your goals and what you're wanting to do from that principle. But when you consider if you're retired, you're drawing an income from your investments, this portion of your investments, you cannot draw an income from. So you can't draw a regular amount out. You can't take out a few $1,000s for the purpose of living expenses or whatnot on a regular basis. It's whatever money is in these products is locked in these products. Now you can draw it out, but you're losing that capital guarantee feature.
Yeah, I mean, one of the strategies that I've used before in the times that I have used the guarantee is you kind of blend the portfolio. So let's just assume that you had $200,000 to invest. You may turn around and say, okay, I'm going to use $100,000 and I'm going to invest in a capital guaranteed product for a period of 5 years. And with the other $100,000, I'm going to split that up and use that to draw income from it to meet my income requirements and have the guaranteed product and the other product sort of running alongside of each other. And the idea is that you can still meet your income requirements in the medium and longer term. And then once that money either depletes or once that time frame of the guaranteed product matures, you've also got that as well. So there are ways from a strategic perspective to be able to use these products and still be able to get a little bit crafty to be able to meet income requirements or pension drawdown or whatever it may be. So there are some ways around that, absolutely.
Yeah, that's where I see most of the use of these products. Similarly, I've had a client in the past where they've had an amount of money in super, and let's say there's $1 million in the superannuation fund. They've retired and they need some income requirements from that superannuation fund. Basically, there's a million different scenarios, but we want to look at two simple scenarios or two simple options that they can take. Option number one is you move your investments to a more defensive asset class. So you are exposed more towards fixed interest and less towards shares, property, and infrastructure. you move the entire portfolio towards that. Now, what that means is that you're expecting a lower growth rate because you're not having the same exposure towards growth assets. And you hold that until, eventually, touch wood, you pass away. Now, in that instance, we're taking a lower growth rate in order to keep the portfolio capital defensive at a time where you're not contributing to it and you're drawing money out of. Scenario number 2 is, okay, you say X amount of money, and let's just do easy numbers, 500,000, you do that too. So you move it towards greater assets in fixed interest, which reduces your volatility and risk so that you can draw an income out of. But the other 500,000, you move towards a capital guaranteed asset that's, you could have exposure to 100% in shares, property, and infrastructure. So you've got 100% exposure to growth assets that has the ability to grow at rates of, pick your number, 7, 8, 9, 10% rates of return. You achieve your growth out of that asset. And on the flip side, you pay a little bit more for it. You might pay that extra 1.5% in terms of cost in entering these products and cost in maintaining these products, but your growth exposure is so much higher while you're still not taking on any risk. So having that blended portfolio is really the scenario where these products can be extremely powerful. Or alternatively, where it can also be very powerful is I've got a planned expense in X amount of time and I have the money there and available today. What do? Do I leave it sitting in a bank account, or do I invest it in an asset class that has exposure to growth by taking on no risk? Simple and easy one is, let's say you've got an amount of money that you want to pay towards child's wedding. Well, maybe you don't know when it's going to be, so that's probably not a great example, but this is when I'm going to have that expense. I've already got the money there for it now. I don't want that money to deplete because I've got a planned use for that money. So I'm going to invest it in a capital guaranteed product. I know that I'm going to pay a little bit more for it, but I've got the peace of mind that whatever happens, I'm going to have the minimum amount, but I'm still going to be able to have exposure to growth.
Yeah, I mean, look, in terms of who this product is suitable for, that is an absolute perfect example in that case. Retiree clients is obviously one that's critical. Really, anybody that's looking for stability with their portfolio and can't digest, I guess, a capital loss. Nobody likes losing money, and who are prepared to forego the costs associated with it in order to pursue that option and that peace of mind. And then the truth is, we all need to continue to grow wealth just because cost of stuff gets more expensive and things like that. But if investment markets are something that make you nervous, thinking about potential volatility and your portfolio potentially going down, these products could be something to consider, because the truth is, we talk to people about it all the time. You have to be invested to grow your wealth, or at least to preserve your wealth to keep up with the cost of living. I mean, that's pretty relevant at this point in time with higher inflation. But if that's in your position, you're really nervous about, I'm worried about the stock market, it's gambling, I'm going to lose all my money, but I know that I need to do something, this would be a perfect product for you to consider and to see if this could work for your circumstances.
Yeah, and I think that's an important thing to note as well. I mean, if you're talking about a 5 or a 10-year horizon, most financial advisors or anyone that's working in finance is going to tell you that, yes, it gives you the peace of mind, but financially, you're probably not going to be better off by investing in a product, because the likelihood is that the market is going to be worth more in 5 or 10 years' time, unless you're locking in the growth each and every single year. However, you can't downplay the mental aspect of investment. It's not the emotional aspect of an investment. It's not just purely what the numbers say and what the odds are, because obviously for a product manufacturer to offer something like this, the likelihood is that it's skewed in their favor. But the sleep test, which is what we'll constantly refer to, is you can sleep at night and you can feel comfortable each and every single night knowing that your investment will never decline in value. And for some people, the price is worth paying for that peace of mind. For other people, the answer is no. And so all this is just another tool in our arsenal to be able to cater to a market of people that otherwise wouldn't have been investing and would have been just leaving things in term deposits and cash and not putting money towards investments, rather than trying to push this towards people that do have the appetite to risk and do have the time frame for investment to be able to reduce their risk. So it's just a different product for a different person.
Yeah, and look, all of the times that we've used these products within the practice, it's never been a standalone strategy by itself. It's always been, yes, there's a capital guaranteed product in a blend of a few different things, but it's one part of a broader strategy. We've never deployed this where this is the only solution. That's interesting enough to point out, because we're trying to tick a particular type of box here with this. But But yeah, they are great products that are becoming more and more prevalent, at least now in a period of high volatility. It gives us, like you said, Andrew, it gives us another tool in our arsenal. Clients seem to be resonating with it because even though they are expensive, it does give people a peace of mind. And it's just another thing for us to be able to create a strategy and a portfolio that continues to achieve the objectives that we're trying to achieve, plus giving clients the added peace of mind that they know that the money that they're going to contribute to this is going to be capital guaranteed for whatever the period of time is for that particular portfolio. So yeah, they are great products. They can work, and we are using them more and more each and every day.
Yeah, and the other thing to just note here, I mean, obviously it's not likely, it's extremely unlikely, but just like investing in a term deposit, yes, you look at it and say that it's risk-free. It's not actually risk-free. If you're investing in a term deposit and the bank goes bankrupt, your capital can be exposed. Similar in this scenario as well, is the product manufacturer and the person, or the product owner, the person that's selling those products, there is a risk that that company goes bust, that company goes bankrupt, and that is really the risk in all of this. And so one of the things that I would strongly advise is when you're looking at capital guaranteed products, much like term deposits, you're not looking at your very minute lenders, you're not looking at small businesses, you're looking at doing this with a big reputable company because you're embarking on it for the purposes of peace of mind. And if it's not going to have that peace of mind that what I have is going to be there at the end, then it's probably not the right company to be going with.
Yeah, and look, that's a consideration that we take into our research, and when we're putting strategies and selecting product manufacturers, that's something that we look at all of the time, because there's no point in getting the peace of mind of a capital guaranteed product if there's a question mark over the top of the financial viability of the people that you're investing with. But no, interesting enough to point out, Andrew, and I think that that's important with all the investment decisions that you make. But look, I think we did that one a whole heap of justice, Andrew, and I hope that gave our listeners something new to think about, because it's not something that we've seen in the marketplace or is usually talked about when markets are good. It's only when volatility starts to increase that these sort of come to the surface again, but it's important that we're talking about them. And hopefully we gave our listeners a whole heap of things to think about and consider whether or not one of these potential products is relevant for their circumstances.
Yeah, absolutely. Thanks again for another great podcast, Billy. Thanks again to the listeners. Once again, please feel free to reach out to either myself or Billy. Details are in the show notes if you want to look at your own personal situation and see whether this is something that's viable and potentially right for you. But thanks again, and look forward to seeing you all on the next podcast.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.